Charge, dude.
All right. Welcome to episode 21 to a very special guest, my actual father.
Hello, Josh.
Do you want to introduce yourself or just want to stay known as dad?
What do you mean actual father? You mean there's more than wouldn't you just say my father?
Well, I mean, yeah, no, I don't think, yeah, you're not wrong.
Because I definitely, yeah, I didn't meet you till you were a day and a half old, but I've been with you your whole life, so I'm your dad. Yeah, I'm pretty sure of that. But no, I don't have to stay
100%.
as your dad. Your name's Josh Bear. My name's Martin Bear. Yeah, I'm your dad.
So today we want to talk about the things that I don't understand about economics because you're good at explaining that.
Well, that's a really broad topic.
Exactly. It's easy.
Like you need to make sure you explain to people, I'm not an economist, I'm a veterinarian. um, I understand business, I understand finance, I understand banking, I understand balance sheets, I understand cash flow, I understand supply and demand, and I've been an active investor most of my life. And I would say I've been a primarily only an options investor in the last 5 to 6 to 7 years. I don't trade a lot of equities. I really only trade options. But I still also work for a living, although I only work part-time. So my schedule is kind of built around managing my accounts, and managing my veterinary practice. And it's kind of a 50-50 thing right now. So I'm invested in Canadian stocks. I mean, I'm like most Canadians. I have an RSP and all that kind of stuff. And these are not options. You cannot buy options in Canada. That's not possible. Um, so, well, it is possible, but the bid ask is so wide, it's just a useless waste of time. So I'm an options trader in the United States and the US markets, New York and NASDAQ. And I'm only a Canadian equities trader in Canada. And I don't really trade Canadian stocks. I own bank stocks and oil and gas and gold companies and telecoms and those kinds of things, dividend paying stocks. And I don't trade them because it's not really possible. So I just own them and I hold them, and I'll hold them for 5 to 10 years, and hopefully Canada won't continually to fall in the sinkhole that it is falling in, and hopefully I'll make some money out of that. But the last 5 years, most of the income I've earned as an investor has come from the US markets, not the Canadian markets.
So,
Um,
how do you do that? How do you have an American account as a Canadian?
well, you have to register. It's all done through Canadian banks. It's through the TD Bank. So TD, Toronto Dominion Bank, has an American branch of it called TD Ameritrade. Um, so you can open up an account at the TD Bank that's denominated in US currency, because if you're going to trade Canadian stocks, you have to do it in Canadian currency. If you trade US stocks, you do it through US currency. So you have to convert Canadian dollars into US dollars. And then you use that fund to buy and sell stocks and options on the Chicago Board Exchange and the NASDAQ and the New York Stock Exchange through a Canadian account, but denominated in US dollars. And that has to be a cash account in a sense. It can't be a registered retirement plan. There's limits, and I don't know what the rules have changed, but it used to be, I think, only 20% of your RSP could be in US dollars. Whereas when you have a US account, it's 100% US. Right? And I was fortunate because I saw the writing on the wall, maybe because I'm a pessimist over in Canada. 7, 8 years ago, I converted a fairly large sum of Canadian dollars into US dollars when we were at par. It used to be, in my lifetime, it's happened twice. And I just turned 60, as you well know. Well, when I was a kid in 1972, 1973, I worked in a grocery store in the Yukon, where I'm from. And I remember exchanging $1.02 to $1.03 to US dollar. Alaskans used to come in and buy stuff, and they'd give us American dollars, and we'd have to exchange it, right? And at that time in the early 70s, that was one Canadian dollar was worth more than the US dollar, right? You could buy, I think it was up to about $1.02, but call it parity, right? And that never happened again until, I want to say, several years ago, when the Canadian dollar again went very close to $1. I think it went to 96 cents. And when that happened, I took a whole chunk of my available equity in Canadian dollars and I converted it all to US, which was a good move. Had I done nothing, I mean, it's up 30% because what's a Canadian dollar worth now? 65 cents?
Yeah.
On its way to 55 cents. So that was a good move. But yes, so yes, to answer your question, sorry, that's a long-winded way of saying it, but yes, you can own US stocks in a US denominated account in a Canadian bank.
Is it possible to have an American bank account? Like,
Does that answer your question?
yeah, I mean, kind of. I mean,
In like as in Citibank or Bank of America? I don't think so. I don't think so. I don't. I wouldn't even. I don't know if that's legal. I don't know if it's allowed. I doubt that it is. I doubt that you can. So what you have to. So the TD Bank has a subsidiary, or the TD Ameritrade, and within TD Ameritrade is a trading platform called Thinkorswim. It's called TOS, and it is a trading platform denominated in US dollars. That's what I use.
I'm trying to get this podcast monetized, and they only pay to American bank accounts. Like, I tried to put in my numbers, but they have like, a different setup.
I think you can get it. Can you get an American bank account? That's a good question. I don't have an answer for that. I've never tried.
Yeah, I don't know. I've been looking into it. I haven't made any progress at all.
But there have to be a lot of Canadians that podcast that monetize their podcasts. How do they do it?
I don't know. It's just this Anchor monetized ads only pay out for American people so far, I guess is how it works. I would have to have like my own website, I think, and then just directly monetize it.
You'll have to figure it out, dude.
Yeah, I'm not too worried about it. It's I'm not doing the podcasts for money,
So what else about investing did you want to talk about? Did you
I mean, I don't really know what you mean when you say you trade options, and like you were saying options are only an American thing.
Well, so you can buy options on Canadian stocks through the Toronto Stock Exchange, but they're so illiquid that it's a waste of time to do it. So do you understand what options are in the first place?
No.
Okay, so let's say you want me to just give you a brief explanation of what they are?
Sure. I mean, of course.
So, I mean, options have been around forever. Options are a derivative, essentially, of stocks. So if you were going to buy and you wanted to invest in Amazon, I mean, Amazon today is a $1,900 stock, $1,900 US dollars. So for you to buy 100 shares of Amazon would cost you 190,000 US bucks, right? 250,000 Canadian for 100 shares. Well, there's not a lot of people around that have that kind of money sitting on the side to do that. So in order to participate in something like Amazon, you could just buy one share, and one share would cost you what, 1,900 bucks, right? Well, let's say you only have a $10,000 account. Well, that's going to be a difficult thing to do. So that's where options come in. And an option is as a derivative of an actual stock, or the underlying is what we call it. There's only two kinds of options. There's only two options. There's puts and there's calls. And there's only 4 possible trades in options. You either buy a put, or you sell a put, or you buy a call, or you sell a call. 4 things. That's it. That's the only things you can do in options. Now, all the complex spreads, and if you ever study options and you hear people talking you hear people at a bar trying to be impressive and impress the women talking about options, they talk about all complex spreads like straddles and strangles and iron condors and butterflies and all these very esoteric names. But all those are, and they're all true, all those are is combinations of either buying a put, selling a put, buying a call, or selling a call. That's it. You take those 4 things, you multiply them different ways, you play them around, you do this, you do that, and the next thing you know, you get all these complex spreads. But in its simplest form, if you buy a call, all you're doing is you're buying the opportunity to buy Amazon at a certain price at a certain time in the future. Options differ from stocks and primarily in that they have an expiry date. So let's give you an example. So Amazon today is $1,900. And Josh Bear sits back and he thinks, well, the world's going for a crap. So I really don't think Amazon's going to go up. Now, I think Amazon in the long term is going to make money. I mean, do you think Amazon's going to go broke tomorrow? I don't think so. I don't think Amazon's going to go broke.
Like they probably have a pretty good month. Everybody's sitting at home.
Well, if it's assuming that their supply chain works out.
Yeah, if they can get the orders out.
If they can get product. But let's just assume that you believe Amazon's going to go down to 1,500. You say to yourself, the world's taking a big crap right now, and I want to buy Amazon, but I don't want to buy it at 1,900 because I think it's going to go to 1,500. And there's a lot of ways to go about that. You could say to yourself, well, on a cash flow, on a PE multiple, on a 5-year technical chart, certain retracement. There's a whole bunch of there's 100 different ways of looking at that price of 1,900 and coming to the conclusion that it's going to go to 1,500. Because that's essentially what that's a 20. Let's call it a 20% haircut, right? You take 20% off Amazon, 20% of 1,900 is what $380, right? So 1,600. If you think Amazon's going to go to 1,500, whatever metric you use to make that decision, whether it was based on fundamentals, technicals, chart analysis, or just your general paranoia, you could say to yourself, well, I think what I'm going to do is I'm just going to wait. I'm going to sit here like a little possum, and I'm going to wait for Amazon to get to 1,500. And maybe it's going to get there in 6 months. Maybe it's going to get there in a year. God knows. Maybe it's going to get there next week. I don't know. But that's what you say to yourself. That's a choice you have as an equity investor. I got $10,000 and I'm going to sit and wait. I'm going to be really patient. I'm going to get up every morning. I'm going to look and see when Amazon hits 1,500, I'm going to buy it. Well, what an option trader would do, he said, you're a dumbbell. What an option trader would do instead is he would buy either he would buy a call on it right now. He would sell a call right now, and I'll explain what that means, but he would sell a call right now, and then he would also sell a put. And the put and the selling a put and selling a call are totally different. If you sell a call, you are obligated at someone else's discretion that you have to sell Amazon at that price. And if you sell a put, you're obligated. If someone asks, if the bank forces you to, you will have to buy Amazon at that price. But you just decided you're going to buy Amazon at 1,500. You've decided 1,500 is the place to do it. So the way you exercise that, if you're an options trader, is you do something called selling a put, which means you have given someone else the right to put that stock to you. That's why it's called selling a put, because they're going to put it to you. If you sell a call, it means someone's going to call it away from you, which means you sold it. But let's go back to make it simple. $1,500. Josh Thomas says to himself, Amazon's going to 1,500, and by God, I'm going to buy it when it gets to 1,500. So what I'm going to say is, well, I'll tell you what. Why don't you just sell a put? Because if you sell the 1,500 put in Amazon, and if you think it's going to take 6 months, well, what you could do is you could sell that 1,500 put every 45 days. The primary option, the primary time that we buy and sell options is a 45-day window. It's not a year, it's 45 days. So today is, I've got a chart, I've got this thing right in front of me. Today is the early April, right? So 45 days from now is mid-May, right? So the mid-May expiration, because don't forget, all options expire. Options don't last forever. They have an expiry date. And when you have an option, before we get back to the $1,500 analogy, you should think of an option as an ice cube in your hand. And an ice cube in your hand, if you have very cold hands, that ice cube is going to last 45 days before it melts into nothing. And when it melts into nothing, guess what it's worth? Guess what an ice cube's worth when it melts into water? Nothing, no. Right? So by definition, that means you never want to buy options. You only ever want to sell them. Because if you're the guy buying an ice cube, why would you buy an ice cube that in the next 45 days is going to melt into nothing? Because what's going to happen every day when that damn ice cube melts in your hand? It loses value, right? Every day it loses value. For the next 45 days that you're holding on to that ice cube, and let's say that ice cube is a $1,500 put. So the $1,500 put in Amazon, stay with me for a minute here, bud. A $1,500 put in Amazon, think of it as an ice cube in your hand. And over the next 45 days, that ice cube is going to melt. It's going to just turn into water, which means in 45 days, that put, unless it's lower than 1,500, guess what it's worth?
Nothing.
It's worth nothing. Now, if you bought that put, that would be a bad thing because you own that ice cube. You want that ice cube to get more frozen and bigger. But when you sell that ice cube, it means that you profit when it disappears because you sold it. You didn't buy it. You sold it. So
That's
give you an
so
example.
confusing. How does somebody buy a thing? No, how do you sell something without having to buy it?
Well, that's how options are. Now you can short a stock, right? If you wanted to short Amazon, what you could do is, if you were a gazillionaire, you could go to the bank and say, I think Amazon's going to 1,500, so I want to short Amazon at 1,900. What the bank will do is they will lend you 100 shares of Amazon and you sell it. So you didn't actually even own it in the first place. That's how shorting works. So you short Amazon at 1,900. When it gets to 1,500, what do you have to do? You have to buy it back. You sold it. So now you have to buy it back because guess what? The bank wants their 100 shares back, right? You borrowed 100 shares from the bank. You sold that 100 shares to somebody else. And now you want Amazon to go down to 1,500 so that you can buy it back and give it back to the bank. Well, that's a great idea, except the margin that you need to sell 100 shares of Amazon is astronomical. You want to sell 100 shares of Amazon, it's worth 190,000 US dollars. Well, that means you have to have a whole lot of money in your bank account, right? You got to have 190 grand in your bank account. Now on margin, you might need a little less than that, but you still need a huge chunk of money to do that. And what if Amazon goes to 2,300? Well, the bank's going to call you in desperation because they know you shorted Amazon and it's going up, not down, which means you're losing money every day. So the bank looks at you and says, how are you going to pay us back? And that's when you get something called a margin call. That's when the bank calls you and says, by the way, Josh, you it's 2,200. So you just lost 210 grand. Where are you going to come up with 210 grand? So if you want to make a bet that Amazon's going to go down, you don't want to short it. What you want to do instead in that situation is you buy that put. So it's a $1,900 stock. You could sell the 1,900 put. And as Amazon goes down, you make money. But think of it again as an ice cube. That $1,900 put, because don't forget, we're talking about a $1,900 put or a $1,500 put, right? The $1,900 put is an ice cube. You just bought that ice cube. Now that ice cube, let's say Amazon stays at 1,900. It just sits there and doesn't move. It just stays at 1,900 for the next 45 days. Well, the put that you bought cost you money. That's the ice cube in your hand, and it's just melting, which means it's worth nothing in 45 days. So everything you bought, everything you paid to buy that put was predicated on the fact that Amazon would go down. But Amazon didn't go down. It stayed at 1,900. So you lost everything that you paid. Now, if you were a smart guy, you wouldn't buy the ice cube. You'd sell it. So now as that thing drips in your hand, you're just counting your money. And the way you do that is you sell a $1,500 put. So I'm going to give you an example of how you'd go about doing that. So that $1,500 put today is basically worth $20 US times 100 shares. That means that if Amazon stays above 1,500 in the next 45 days and doesn't go in the money, it means you're going to make 2,000 US dollars. So you're going to sit there. That ice cube you just sold. You sold that ice cube for $2,000, right? You sold it for $20, but it's always denominated in lots of 100 shares. So whatever you sold it for, you times it by 100. So $20 times 100, there's $2,000. So that ice cube in your hand is worth $2,000. And every day in the next 45 days, if Amazon stays at 1,900, guess what happens to that put? It gets more and more worthless. It's not worth anything. The only way it gets value is if it goes down to 1,500. And you just made a bet that it would go close to 1,500, but you're betting it won't go lower than 1,500. You are willing to buy Amazon at $1,500, right? You thought Amazon's going to go down to 1,500. That's a great place to buy it. I'm going to buy Amazon at 1,500. And I'm going to say, and you're going to wait. And I'm going to say, well, I'll tell you what, I don't think it's going to go to 1,500. It might get close. But in the next 45 days, do you think Amazon's going to drop 30%? Is the world really going to take a dump that bad? I think the answer is no. So I'm willing to make a bet Amazon stays above 1,500. But I'm not going to then wait for it to get there. What I'm going to do instead is I'm going to sell a $1,500 put. If I sell the $1,500 put, the bank's immediately going to give me $20 per share times 100 shares, $2,000. I get $2,000 and I get to hold that $2,000 for right now. And then Amazon over the next 45 days, it's good. Let's assume the world does what you think it does. And it goes down and down and down. And Amazon closes at $1,502. Well, the only way that that put has any value is if it gets to $1,500 minus a cent. So $1,499.99. Now that put has value to it. It's worth something. There's a little tiny chunk of that ice cube left in your hand. But if it stays above $1,500.01, that $2,000 put that you got, the $2,000 you got is worthless. And you want it to be worthless because you didn't buy it. You sold it, right?
You say right, but I'm so confused.
Okay, so at the end of 45 days, you just made $2,000 because Amazon didn't go to 1,500. It's still at 1,900. So guess what you do?
I get it. It's just
you do it all over again. You do it one more, and you just keep repeating that over and over and over again.
It's such a
so essentially,
system.
When you trade options, all you're doing is you're either buying a put or you're selling a put. You're buying a call or you're selling a call. They are four very different things. They mean four very, very different things, and they all have a very precise action. Two of them are very bullish, meaning they anticipate that the market of that stock will go up, and two of them are very bearish. So you have to make a decision on Amazon. Do you think Amazon's going to go up, or do you think it's going to go down? And when you make that decision, you can put your money where your mouth is, and you can do that by either buying or selling Amazon. But since it's a $1,900 stock, that's very difficult to do. So you learn how to trade these four simple options. And when you do that, it allows you to participate in either the downside or the upside with much less margin, right? It allows you to do it with much less money in your account. Does that make sense? Not really.
I mean, it's not that it doesn't make sense. It's just, it's such a foreign sort of game. It's so much like gambling.
See, and that's where when people say that to me, I say to them, okay, well, how is buying a stock not gambling?
Well, I don't say it like it's a bad thing. It's just like when you hear about all these options of like essentially placing a bet whether or not it'll go up and down, and you want to be the one that sells that bet to someone else rather than buying it from them, because then if it doesn't come through, you're still like, there's so many levels of this that are
right.
like a
so
like a
another very simple way to think of options, which is the best entry argument to do it, is if I came to you and your friends and I said to you guys, okay, I have two games we can play. And one of the games that I have, you have a 10% chance of winning $1,000. And the other game we're going to play, you have a 90% chance of winning $10. So it's the reverse. Which game would most people play? And guess what? Most people choose the 10% to win $1,000. But an option seller, and that's what buying options is. But when you sell options, flip that coin. When you sell an option, you have a much higher probability of profit, but you have less profit. And that's a game that you rinse and repeat. You do it over and over again. You're the house instead of the sucker sitting at the blackjack table. The house has an edge, right? Otherwise, they wouldn't have great big casinos. The house has the edge. The punter sitting there doesn't have the edge. The house does. And when you sell options, you're the house. When you sell options, you're playing a game that has a higher probability of success with less profit, right? And I think the options are the opposite of gambling. The only way that options are risky is when people are selling naked options with very high margin. And that's more of a complicated thing. But the way you avoid that is in your example, in my example, my account's large enough, I can sell a $1,500 Amazon put and I can withstand that margin. And I'll tell you, for example, if you did that $1,500 put, if you were going to try to sell that put, you would need, you would need 52,000 US dollars. So unless you had $52,000 in your account, you can't do that. You will not be able to sell that option. So what you would do instead is you'd say to yourself, all right, self, I still think I want to sell the $1,500 put because I do not think in the next 45 days that Amazon's going to go lower than $1,500 because that's the bet you're making. That's the exact bet you're making. You're selling the $1,500 put because you do not think that anyone is going to force you to buy Amazon, because the only way they would do that is if Amazon was less than 1,500. And Amazon, you don't think is going to go less than 15. But since you don't have 52,000 US, well, then what are you going to do? Well, here's what you do. You still sell the $1,500 put, but now you buy the 1,490 right below it. So what you've just done is called a spread, right? So when you sell a $1,500 put, that's naked, right? Because there's no protection. But if you buy the 1,490 put below it, it means that if Amazon did go to, what if Amazon went to $1,000? Well, if you were forced to buy Amazon at 1,500, and by selling the put at 1,500, you are giving someone the right to put you the stock at 1,500. And if that happened and Amazon went to $1,000, guess what you just lost? You lost $50,000 because you got put the stock at 1,500 minus the premium that you got, which is $2,000. So let's call it 1,480. So you lost 48,000 US dollars if Amazon goes to 1,000. Well, Josh Thomas Bear doesn't want to do that. So what he does instead, the smart little guy, is he says, okay, then why don't I buy the 1,490 put? So now somebody is going to put you the stock at 1,500, right? Stock goes to 1,000. World falls apart, Amazon goes to 1,000. So you get put the stock at 1,500, but you get to cover that stock at 1,490. So there's only a $10 spread, right? At 1,490, you are now short the stock. So your only risk is between 1,500 and 1,490, not all the way down to 1,000. And for that, you receive $1.15. So you make $115 to take the risk that Amazon will stay above 1,500. And the only risk that you have is the difference between $115 and 1,000, which is 10 points. So you're risking $885 to make 115. So that's called a spread. So that is not gambling. That is making a bet that Amazon stays above $1,500. And the only, guess what, remember how much margin you needed for a naked $1,500 put? 52,000 US, right? Well, in order to do this spread, you only need $885. So you're putting up $885 in margin. And if you had a $10,000 account, that means you've basically used what? 8% of your account, less than 10% of your account. So you could do this 10 times on 10 different stocks. But you've risked $885 to make 115. Now, I wouldn't call that a very good bet in the sense that in general, when we do spreads, when you sell a spread, you want to have a third of the width. So if it's a $10 spread, instead of $115, you would have wanted to collect $375 or $360, which means now your risk was only 640 as opposed to 360, right? So you do that 100 times a month. And at the end of the next 10 or 15 years, you're living in a great big fancy house, right? Because the probability is on your side. Now, gamblers, as you describe them, would say to themselves, well, but I think Amazon's going to go up. So I don't want to make $115. I want to make $1,000. So you're going to take a bigger risk, right? And a bigger bet, right? You're going to be the guy that wants to have a 10% chance of winning $1,000. And I want to be the guy that has a 90% chance of winning $100, $10, right?
Yeah.
I want higher odds with a lower payout. And I'm going to repeat that every 45 days, right? And I'm going to go to sleep at night and I'm going to sleep just fine, right? Because my risk has been calculated and my risk has been accepted. And I know exactly what I'll win and exactly what I'll lose. I know what my profit will be and I know what my loss will be. When you buy a stock, you have no idea. If you bought Amazon at 1900 today, you're taking a 50-50 shot, aren't you? You can't tell me that you know it's going up tomorrow or down tomorrow. Who the hell knows? No one knows. Anyone who thinks they knows is a fool or a liar. So you don't know what Amazon will do tomorrow. So if you buy that stock, you're taking a 50% chance that that stock will go up or that stock will go down. But if you are buying if you're selling the $1,500 option and you're doing it on the 15th of May, we call it the delta, the probability is 10%. There is only a 10% chance. 10%, that's what the options market has calculated. And the options market is very sophisticated. This isn't just some guy sitting in his basement in New Jersey figuring out what he thinks the odds are. It's not a bookmaker. This is hundreds and hundreds and hundreds and hundreds of thousands of calculations that are done by hundreds of thousands of different people and different brokerage firms and options market that determines what that probability is. This isn't just made up. And it's 10%. It's a 10 delta. So the $1,500 stock has there's a 90% chance based on what the option market calculates. 90% that Amazon stays above 1,500 in the next 45 days. And so if I sell that option, if you have the count for it, I'm going to make $2,000 on that stock. And there's a 90% chance that I'm going to make that, right? And I'm willing to take that bet.
And what's the alternative situation if it doesn't go according to your plan? Do they take the thing that you sold from you, or?
What do you mean? Sorry, I lost you. So if Amazon goes below 1,500 in the next 45 days, someone is going to put it to you. That's what selling a put means. Someone is going to put it to you because you sold it. When you sell an option, you have an obligation. When you buy an option, you have the right. So if you're the one, if you're the smart guy here and you say to yourself, well, I agree with my dad. I think Amazon's going to go down and I think it's going to go all the way to 1,500 and you have the money, you would buy the put. So you would say to yourself, it's a 1,900 today. So you're going to go and look at your chart. You're going to say, okay, I think Amazon's going down. Guess what a $1,900 put would cost you right now? It would cost you $120, right? It would cost you $120 times 10. What's that? $12,000, right? So it would cost you $12,000 to make the bet that Amazon's going to go down in the next 45 days. And I'm going to make the bet that I would not want to spend $12,000 to make that bet, because what if it doesn't? If it doesn't, that $12,000, that's a very expensive ice cube in your hand. That's a $12,000 ice cube sitting in your hand. And every damn day for the next 45 days, if Amazon does not go down, that thing's melting in your hand. And every day it's getting less and less valuable, right? So
I think I kind of understand. I mean, I get the idea that once you lock that in, then if it doesn't meet that criteria, then you've like wasted that money.
Right. You wasted the premium, which is why you don't buy options, you sell them. And if you have a large account, you can sell them naked. But if you have a small account, in the United States, for example, they call this an IRAs, right? Well, you're not even allowed to sell options naked in an IRA, right? In investment or retirement accounts, because it's too risky. Risky in the sense that if Amazon went to 1,000 and you had sold the 1,500 put, someone is going to put that stock to you at 1,500, but now it's 1,000. So you just lost 50 grand, right? That's not good. So the only time I buy options is when I'm using them to protect my naked position. Meaning, I think Amazon is going to stay above 1,500, but I sleep better at night if I know that if it did go down to 1,000 in the next 2 weeks because terrible things happen in the world, then I would have some protection. And the only way I have protection is to put my naked put in a spread, which means I'm going to sell the 1,500 and then I'm going to buy the 1,490 or the 1,480 or whatever I want to protect my downside, right? But at the end of the day, if you had a US account and you only had a $10,000 account, I would, if this was you, if you came to me in 5 years and said, okay, Dad, I got 10 grand, I'm going to get a US denominated account and I want to start investing in that, then I would absolutely want you to learn how to do options, because you would be able to express your opinions in the markets, whether it's an up opinion or a down opinion. You'd be able to express that opinion through options in a much more effective way than buying stock outright. And you put the probabilities on your side. And I would convince you that you would never want to outright buy options ever. That's a sucker's game. That's the guy that has a 10% chance of winning $1,000. I would convince you to be the seller of options, which means you're the guy that has a 90% chance of winning $100, which is like the example I just showed you.
So, to kind of get like a handle on how I would go about selling options on something if I'm just beginning, like if I'm just beginning and I don't have anything to sell, how can I sell options?
Well, you just have to have the margin for it. You have to have an account large enough for the margin. And like I said, if you want to sell the $1,500 put, and I'll go back to it again, and I'll click on that and see how, well, then you need to have $52,000 in your bank account. If you have $52,000 US in your bank account, then the options market, your brokerage firm, will allow you to sell that put at $1,500, because they think if it does get to 1,500, you have enough money to cover the cost of it, right? You have the money for it. But if you don't have 52,000, well, then you have to hedge that. You have to protect yourself with a long put or a long call. If you sold a call, then you'd have to buy a call above it. If you sold the put, you'd have to buy a put below it. And you'll have to learn those different things. That's to the scope of right now, trying to explain how that works. But that's essentially, you've taken a naked option that you sold and you've hedged it, right? You've covered your arse. You bought insurance. And when you buy insurance, that's called creating a spread. And the vast majority of people who are just starting at this absolutely should only be buying spreads, or should only be selling spreads, right? You should never buy a naked position. That's just too much risk.
So you're, to sum it all up and boil it down, you're saying that people out there getting into this should 100% sell options.
They should sell spreads. They should sell option spreads. Absolutely. They should educate themselves. If they have smaller accounts, they should get a US denominated account. They should understand the mechanics of options. They should never do this ever until they know what the heck they're doing. I mean, this is never, because your sister, the lawyer, wanted to remind me to make sure people understand that this is not advice of what to do or what not to do. This is just educational, right? This is just a little conversation, two guys having a conversation.
Of course.
Anyone who wants to begin to trade options 100% has a long track record. I mean, it takes a very long time. They need to study it. They need to know exactly what they're doing. They should paper trade for a long time, right? They should do this on paper. You can get paper accounts, right? You can get a paper account, Josh. You could open up an account in Thinkorswim that's called Paper Money, and you could learn to do this with fake money. You could do that for years before you actually do it with real money. And that way you learn how to do it. And once you reach a point where you're comfortable with paper money and you understand how options work, naked options, option spreads, how complex things like straddles and strangles and iron condors and butterflies work, then you can do it with real money. But when you hear people talking about options, remember, there's only two options. There's a put and there's a call. So there's only four things that you can do. You can sell a put, you can buy a put, you can sell a call, or you can buy a call. Those are the only four things you can do. And it's how you do them in relation to each other. It gets very complicated. Yes, it certainly does get complicated. You need to understand probabilities, but you don't have to figure it out yourself. I mean, options markets have option chains. Every brokerage that you have will have an option chain where their calculations are done that will tell you what the expected probability of a stock moving to a certain price at a certain point of time is. Right? It's very well determined. It's determined by time. It's determined by what the volatility of the market is. It's determined by interest rates. It's determined by, it's called the Black-Scholes model. But there's these different inputs into the calculation that made somebody figure out what the options market probability is calculated at for whether Amazon will get to 1,500 in the next 45 days. And the answer they came up with is there's only a 10% chance that's going to happen. 10%. So my dad speaking to his son 5 years from now, when you've got money sitting aside and you want to start expressing an opinion in the markets and you want to start investing for yourself, I would absolutely get you some reading material and absolutely advise that this is where you start. You don't buy junior mining penny stocks, right? Because there again, that's the guy who has a 1% chance of making $1 million, right? You don't want to be that guy. You want to be the guy who's the seller of options, right? And when you get to that point, I mean, there's a lot of different factors. You have to know what the level of volatility is. You have to, I mean, you know what the probability is based on where the price of the stock is and how much time is left. It's complicated in the sense that time is important. The duration of the option that you're selling is important. And the level of volatility in the market is important. And right now, it is nirvana to be an option seller because look what's happening in the stock market. I mean, it's down 1,000 points one day and up 1,000 the next. It's like a cat on a hot tin roof. The volatility is exceptional. And volatility being very high is very good if you sell options, right? Because an option is worth more when there's high volatility as opposed to when there's low volatility. Think of it as an egg in a frying pan. If there's an egg in the frying pan, but the heat is very low, that egg takes a long time to cook, right? It's a very, very warm frying pan, but it's not hot. That's low volatility. That's what the markets are usually like. Things are calm and quiet. Nobody's that excited, right? You know, things are going along, the economy's going along, everybody's happy. Nobody's too excited. Well, think about turning up the heat in that frying pan and now that egg is sizzling. That's high volatility. That's what's happening today because of coronavirus, because of the elections in the United States, because of Brexit, you name it. There's 1,000 different reasons for why the market is jumpy. But there is no denying that the stock market right now is jumpy. It is exceptionally jumpy, right? And when it's jumpy, it means that the premiums on options are very, very high. They call that the juice. It's very high. So you don't want to buy an option with high juice in it. You want to sell it because guess what? In a month, 45 days from now, I'm not sure that the world's going to be any jumpier than it is now. How much jumpier can it get? No, it could stay jumpy, but it's awfully jumpy, right? It's awfully jumpy. And one way that's measured, it's called the VIX, right? So the VIX is a measure of, it's a calculation of how, think of it as jumpiness. It's a measure of how nervous the stock market is. And a normal VIX in normal times is 15. So with a VIX of 15, it means that there's not too much complacency, but nobody's really that worried, right? The premium on options is reasonable at 15. 15 is historically normal. Go over the last 30 years, that's normal. Well, the VIX today is 57. So that's exceptionally high. That is a hot frying pan. That egg is just sizzling. It is sizzling. And when that happens, you don't buy options. You sell them. You just sell them and you sell them and you sell them. So does that make sense? Not really.
I mean, it makes sense, but I'm still not super clear on how you're selling an option if you have no options that you own. Like, can you just go up to a stock and say, I'm going to sell options of this stock, even though you have no, like tokens of holding that stock?
Yes, you absolutely can, but you have to have enough money in your bank account. You have to enough what's called margin. You can't you well let's make it a simple example. Let's say there's a $5 stock, right? And there's or $10 stock. Let's call it a $10. Ford. I don't know what a good example of a $10 stock is these days. There's tons of them around. Hawaiian Airlines is a $9.84 stock. So Hawaiian Airlines is inexpensive. So you could buy Hawaiian Airlines for $10, right? So you buy 100 shares, that's $1,000. But what if you just bought an option on it? So if you buy an option, it means that you're essentially in charge now of 100 shares. One option equates to 100 shares, always. An option equals 100 shares. Whether you sell it or buy it, it's always 100 shares. So if you wanted to buy 1,000 shares, then you would buy 10 calls. So a call is totally the opposite of a put, right? We've only been talking about puts on Amazon because you thought it was going to go down. A call is the opposite. If you believe that Hawaiian Airlines as a $10 stock is going to go up, well, you have two choices. You can sell the $10 put, or you can buy the $10 call. They express exactly the same opinion. Selling the put of Hawaiian Airlines at $10 means you are obligated to buy Hawaiian Airlines at $10 if it goes less than that in the next 45 days. But you've already decided you're going to buy it at $10, right? So you say to yourself, okay, well, I got three choices. I think Hawaiian Airlines at $10 is as cheap as it's ever going to be. They still got planes flying across the sky. Someday people are going to want to go back to Hawaii. It's all good in the hood. We're good, everyone. Let's buy Hawaiian Airlines. So now you have three choices. You either buy you buy 100 shares of Hawaiian Airlines. That costs you $980. Let's call it $1,000, right? And you have a 50-50 chance. You just flipped a coin at $10. You bought the stock. Tomorrow morning, it's either going to go up or it's going to go down, which means it's a 50-50 proposition. So your other choices are you can sell a put you can sell the $10 put, and the $10 put on Hawaiian Airlines right now might not be worth very much because it's only, hang on, so it doesn't want to do it for me. It's because it's not a very big stock, right? A $10 stock is not. Sorry, my computer decided not to work. But let's say that's only worth 50 cents. Well,
Right.
it might be. So you sell a put at 50 cents. That means you make $50, which means your cost basis is actually $9.50. And now you sit back. And if Hawaiian Airlines goes above $10 and stays above $10 in the next 45 days, you get to keep that $50. And then in 45 days, you do it again. And you keep that $50. And you just do that 7 or 8 times this year. The next thing you know, you made $300 to $400 in Hawaiian Airlines, which is the same thing that would have happened if Hawaiian Airlines went up to $13 to $14, right? But the probability that you were going to win by selling the $10 put, in my opinion, is higher than if you just buy the stock. Now, the other third option that you have is you can buy the call. You could buy a $10 call, and a $10 call premium is probably $1. So now Hawaiian Airlines actually has to go all the way to $11 before you make a penny. If you buy the call at $10, and now I figured it out. So now I got my computer just allowed me to go back. So I figured it out for you. In the next 45 days, if you bought the $10 call, it would cost you $2.05. So now your cost basis is what? $10 plus $2.05, $12.05. So if you buy that call, hang on, I take that back. I take it back some. It's $1.95. $1.95. If you buy the $10 call, it costs you have to pay $1.95 to get that. So now you're going to sit there for the next 45 days and you're going to pray that Hawaiian Airlines goes above $11.95, right? Because if it doesn't, you just lost it, right? The $1.95 isn't worth $1.95 anymore. In 45 days, if Hawaiian Airlines is only $11, well, it's only worth $1. You lost $95. Now, if you sold the $10 put, you'd make $1.85. So the bank would give you $1.85. But what if Hawaiian Airlines goes to $16? Well, you're going to make $1.85 or $185. If you bought the stock, it would have gone to $16. You would have made 600. You could say to yourself, "Oh, for heaven's sakes, why didn't we buy the stock? We'd have made 600. Instead, I only made a 185." But the reality is that if you're selling the $10 put, you have a 84% chance, 84% chance that Hawaiian Airlines is going to be above $10 in 45 days. 84% versus 50% if you bought the stock outright. So you had three things to do. You either buy the stock, you buy a call, or you sell a put. And in my opinion, and what I would do in this situation always is I would sell the put, because it's the highest probability. It means that ice cube I have in my hand that's melting away, because in 45 days, options are worthless. After 45 days, they expire. They're not worth anything anymore. That ice cube that it's melting in my hand, every day it melts, is fantastic, because I sold it. I didn't buy it.
Well, there
So
you
that's what you will learn. You'll eventually learn that you have three separate ways. Now you can get into spreads and it gets way more complicated, but from a simple standpoint, if you believe that a stock of a company is going to go up, you have three ways to approach it. And they're very different ways. They have different probabilities. They have different capital requirements or margin requirements. So you have to sort of figure out, which one's appropriate for you. At the beginning of the whole process is you have to have an underlying assumption, which means, do you think the stock's going up or it's going to go down? And once you make that decision, you can use options to express that opinion.
Very interesting. I got a question for you, Dad. So I've been reading about how they printed like $1.5 trillion. Could you explain?
The Fed did. Yeah.
Yeah, the Fed did in America.
Mm-hmm.
What is that? Like, how do you directly tie them putting more money out to money being worth less?
Well, because it's inflationary. I mean, it has to eventually be inflationary. I mean, you'd need economists to describe that better. But when things are as tough as they are in the United States right now, I mean, they really need people to still be liquid. They need people who will still have cash in the bank so that they can go buy things, right? So they can buy groceries, so they can keep the economy running. But if there's 100 people in the grocery store, and each one of them has a limited amount of money, and they all want to buy the same thing, well, that thing becomes much more valuable, right? The less money that you have, well, a better way to describe that, if the Fed is producing more and more dollars, if there's more and more cash in the economy, it means there's more and more dollars chasing after things, which by definition means that the price of those things has to go up. I mean, look what happened in Germany in the early 1930s in the Weimar Republic. I mean, they printed so much money, things became so inflationary that people needed wheelbarrows of Deutschmarks in order to buy a loaf of bread, right?
Or like
in theory,
Venezuela right now.
Yes, in theory, if you produce too much fiat currency, if there's way too many dollars in the world, if everyone has $1 million in their bank account, and I'm being facetious, but if everyone has $1 million, well, then the loaf of bread doesn't need to be $2.95 anymore, does it? Because everyone can, I mean, there's more and more money chasing goods, and the more money that chases goods, well, then the goods are worth more. So it's exceptionally inflationary to produce that kind of ongoing elevation in liquidity. The problem is that it may not work, right? Right now, I mean, why in normal times, that is a good explanation of why the Fed creates and why the Bank of Canada produces the level of interest rates they do. In the interest rate that the Bank of Canada and the Fed create, or that they set, that interest rate doesn't apply to you and me. It applies to the banks. It applies to how Wells Fargo and Bank of America and how the Canadian banks, where they get their money from. And then they use that money to lend to you and me. But if the Bank of Canada thinks that the economy is too hot, I mean, unemployment is at 2%. Everything, there's jobs everywhere. There's business everywhere. It's so strong. The economy is just burning. There's full employment. It's just rocking. Well, the Bank of Canada will have a higher interest rate because they need to make money supply a little more restrictive to cool things down. Because if interest rates are at 2%, well, then everyone's borrowing money and they're buying crap. Everyone's buying houses. Everybody's using credit lines. Everyone's buying cars. I mean, everything's too hot because money is too easy. So the Bank of Canada says we need to slow things down. Things are getting too inflationary. Things are getting too hot. So they raise interest rates. The purpose of them raising interest rates is to slow the economy, right? Is to slow things down. Because if they raise interest rates to 6%, well, then Josh Bear isn't going to have as easy a time going out and buying a new car, is he? Because now instead of financing it at 2%, he's got to finance it at 6%. So it slows things down. It puts a little bit of water on the fire, the economic fire. Now, in the United States right now, interest rates are close to zero. And
Yeah, I was going to say that's something else that I've been reading, that they put the interest rate down to zero.
Right. Because, oh my God, there is no growth in the economy. Things are so bad. They want people to borrow money and invest and build and create. So here, money is free. Go take it. Create jobs. Go buy things, right? They want that to happen. The problem is that they've got to be careful that they don't end up with runaway inflation, right? And there's something called stagflation, which is essentially runaway inflation with no growth. And that's a very, very, very bad thing. They could have money floating around out there where everything's becoming very expensive, but there's still no growth in the economy. It didn't do what they expected it to do. And I'll give you a good example of how times have changed. When I was your age and I just finished university, I remember writing my licensing exam. This is 1990. I was 30 years old, right before you were born. I remember walking outside of my exam, my licensing exam in Guelph, Ontario, and there was a CIBC across the street. And they were offering a GIC, a 5-year GIC, guaranteed investment certificate, for 12%. So I could have gone in there if I had any money, and I could have put down $1,000 and earned 12%. Josh, that's unheard of. I mean, you know what a guaranteed investment certificate will yield you now? Less than 1%, maybe 0.5%, zero, nothing. There is nothing. And this is a really, 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 really good thing if you're a borrower. But if you're a lender, this is not good, right? What about seniors? What about people who need income and their money is in bonds? Their money is in guaranteed investment certificates, it's in treasuries. They're not earning anything. Zero. Those people are making nothing, which is why the government needs, we want our economy to be strong enough that there's good employment, that we have increase in our GDP. We want to grow 3-4% per year, something like that. I don't know what our GDP is right now, but it's not good. It's less than 1.5%. It's not good. The United States is lucky if it's going to get 2, right? GDP is gross domestic product. You want it to be up every year. It has to be up every year. Those people, those savers, those people that are relying on their pensions, they're relying on their guaranteed investment certificates and their treasury bills, and man, they're in trouble because there's no money. I mean, at 0.2%, that's terrible. And that's why in a lot of ways, you look at the United States markets right now, you'd say to yourself, why are they so strong? Well, I mean, they haven't been in the last month, but look at over the last 5 or 6 years, they have been. And it's because they're the prettiest horse in the glue factory. Where else are you going to put your money, right? I mean, you're not going to invest it in the Chinese markets. You're not going to invest it in world markets and other places because they don't have the transparency. They don't have the regulation. They don't have the rule of law the way the United States markets do. The United States markets are the most liquid and reliable markets in the world. New York is where everyone invests because it's where they can trust it the most, right? So if you are a pension fund, if you are responsible for the Ontario teachers pension or the Alberta teachers and all these pension funds throughout North America, where are you going to invest your money? You're not buying treasury bills at 0.2%. You can't. That's not keeping up with inflation. So a lot of that money has to flow into the United States markets, stock markets, because there's nowhere else for it to go, right? There's just nowhere else for it to go. And all of these people, and this is my only political rant, but all of those people out there that are anti-capitalist, right, or that believe that, the stock market is just for rich people, yada, yada, yada. Well, they're just fools, because everyone out there that has a pension, a Canada pension, whether you are in a union and you have a QP pension, you have a government pension, you have any kind of a pension, guess what? Those pensions, they don't have money sitting on the side that because you gave it to them in the last 25 years of your working career. They have money because they invested. The CPP, the Canada Pension Fund, is a sum of money that is invested. And it's the returns on those investments that they give to the people who are earning CPP when they retire. Well, where do you think they're investing it? In the stock markets and in the bond markets and in the treasury markets. They're not getting anything in the bond market. They're sure not getting anything in the treasury market. So they've got to be in the stock market. So the average guy out there that's poo-pooing and talking about how horrible it is, the stock market, it's a capitalist invention. Well, he's the same guy going down to the bank cashing his pension check every month, isn't he? And guess what's going to happen to his pension check? Guess what's going to happen to civil servants' pensions if the stock market continues to melt down? Their pensions they're not going to be funded properly. They're going to be insolvent. Everyone is going to have a very, 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 very big problem. Very, very big problem. Right? The stock market is an essential component of the economy because it's what is used to generate returns on public pensions, on private pensions. It's the lifeblood of the way the Western world works. Without it, we're all in deep, deep trouble, right? Because we're definitely in a recession, son. I mean, what's the definition of recession? Shrinking GDP 2 quarters in a row, I think. I don't know if it's 2. And I don't know what the definition of depression is, but I think the depression is if you have shrinking GDP for 4 quarters. Someone could correct me on it. It's something like that. And anybody who thinks that we're not going to have we're in a recession. We have to be. I mean, have a look out there. How many people filed for unemployment claims in the United States last week? Over 3 million. It was a record. I mean, there's people unemployed everywhere. So our gross domestic product, our GDP, is absolutely shrinking. It's negative. It's going to be negative in the first quarter of 2020. It's definitely going to be negative in the second quarter. So we're by definition in a recession. So save your money, dude. Don't be spending money you don't have on things you don't need because things are going to get tough.
Times are going to be tough.
Yes.
I hear that. It's kind of funny though, because if it does go all hyperinflationary, where $20,000 is worth what $20 is, you know what I mean?
Mm-hmm.
For people like me that owe money, that's a little bit helpful because the money that I owe, unless they inflate that, if they match it, so all of a sudden, what I owe is X amount larger. But if it stays the same, then hyperinflation helps me. It just hurts me.
Well, the good thing about your debt too, when interest rates are as low as they are, is that you're not servicing a great deal of debt. The first car I bought before you were born, I think the interest rate I paid was 18 or 19%. 18 or 19% on a car. Josh, nobody's paid that interest rate in decades. I mean, and think about credit cards. What's the interest on a credit card? 22, 24%? How easy it is to pay off your credit card debt? And the answer is it's almost impossible because people can't keep up with the compounding interest. I mean, credit cards will kill you. Credit cards they're widow makers. I mean, unless you're paying your credit card off on a monthly basis, you're crazy. You should cut the darn thing up and you shouldn't be using it anymore, right? Now I'm lucky because I'm at that point in my life and my career that I have assets and I don't have debt anymore. So I don't have to worry about that. And I'm able to invest because I've built up a nest egg over the years, right? But if I had to express my opinions in nervous investments, if I was one of those guys that said, well, I'm never going to buy anything in the stock market, that's too risky, I'm only going to buy treasury bills. Well, at 0.2%, why don't I just put my money under my mattress? Because that's where it's going to end up, right? I mean, there's no money to be invested in the banks. But, speaking on the other side of that, when you want to talk about the economy, you have to think of what it's like for business people. Like, we own businesses, darn well, about that. So we, in very good times, when we go through expansionary periods where our business grows and we have to hire people, and our balance sheet gets bigger and we have more and more assets and life is good, we don't spend it all. We salt things away. We have a budget on a yearly basis that we estimate what we think our revenue is going to be. We estimate what our expense is going to be. We estimate what we think our return on our capital is going to be. How much money are we going to earn this year after EBITDA, right? So we're going to pay our employees. We're going to pay our rent. We're going to pay our taxes. We're going to pay everybody. We're going to pay ourselves. What are we left with in the business? And we want a nice, healthy number, right? We want that to be a number that we can put away so that the next year or the year after, if it's not a strong year, we don't have to lay people off. We want the business to be sustainable. So, and we're in that process right now. I mean, we're looking out for the next 6 months thinking, holy cow, things are not going to be good, right? So we are being very careful. We're not spending money we don't need to spend. We're being careful about our wage categories. There's certain fixed costs in a business you can't control. I can't control my rent. I can't control my utilities. I mean, I can turn the heat down a little bit, but that doesn't make a big difference, right? There's certain fixed occupancy costs that I have no control over. But I also have very little control over, over the next 4 to 6 months, how many people walk through the door and want to pay for our services. I don't have a lot of control over that. I've had control in the last 10 years of building a business that people wanted to come to. But in the short term, whether they will come or not has nothing to do with whether they believe in me or not. It's to do with what their life looks like, and people's lives are going to look pretty ugly for the next 3 to 4 months. So I have very little. So I have no control over my occupancy costs, my fixed costs to run my business. I have very little control over what my revenue stream is going to be. So I have to make some very conservative estimates, and then I have to look at my categories that I can control, like my wages, right? Like my goods and services that I purchase, like how much, whether I'm going to put out any capital. Am I going to buy a new x-ray machine? Am I going to buy this? Am I going to buy that? The answer is not a chance, right? We're going to batten down the hatches here, right? We got a storm coming. This is not the time to sit out on the deck and have a martini. This is the time to kind of be careful. And the way I always look at it is if that's the way I feel, and I'm just your average 60-year-old small business person, there's a million people just like me, right? There's a million people like me in this country that are doing exactly the same thing, that are all battening down the hatches, which means our economy is about to just get drop kicked, right? Because if I'm doing it, so is everybody else, right? Because I think I am a barometer of your average small business person, $1-2 million businesses across this country. I'm a barometer of what they're doing. But there's not going to be a lot of expansion. There's not going to be a lot of capital being purchased. There's not going to be a lot of growth in wages. There's not going to be growth in the employment workforce. Everything's contracting. Money's going to get very tight for the next little while. So I mean, relative to the economy, I mean, on a daily basis, the economy is something everybody better understand. I mean, I understand it from my investment standpoint. I understand it from running a small business, being on the side of that. I mean, I have to understand all of this. My entire life, and you know this as well as I do, I have a very biased opinion about the way things work this way, because I have never cashed a check. I've always written them. I mean, I've never been an employee in my life. I've always owned my own practices. I've always been an employer. And when you're an employer, you see that side of the risk curve. And most employees don't ever see that side of the risk curve. And so they have a lot of assumptions about, how business people work and how they do this and how they do that. But really, until they've been the ones with the checkbook in their hand and they're the ones writing the checks, they should be careful to judge, right? Because it's a different coat you wear when you sit on the side of the table that is writing the checks instead of cashing them, right?
There's a lot of people that are saying that they shouldn't have to pay their rent during this disease apocalypse. plague.
So, okay, so then what about the guy who owns the property? So
Exactly.
he or she has had to go to the bank and borrow $1 million or whatever the heck it was required to buy that house, or millions of dollars to buy that apartment building and develop that apartment building and upgrade that apartment building. And they have fixed costs. They have to still pay their mortgage. They still have to pay their utilities. They have to pay their insurance. They have to keep money and set aside money so that when the elevator goes or when the windows are all broken, they have to fix it. I mean, the assumption of a lot of people have is that those people that own that property, the landlords, they're all just, they're like McScrooge sitting at home counting their gold. And it's just not like that. they're they take on a lot of risk, and when you take on a lot of risk, um, at the end of the day, at some point in their life, they should be able to cash that, and they should be able to be rewarded for taking that risk. That entrepreneurialism, without that, what are we? What are we? Are we all going to be tenants? Well, if we're all tenants, then who's responsible to fix the building? Who owns it? I mean, that's called chaos. I don't know what that is, but it's not a world I want to live in. So
That's
I don't disagree that there's people that are going to have troubles paying their rent. That's going to be a challenge. But don't forget that the guys who own the buildings, that's going to be a challenge for them too, because what are they going to do? How do they pay their insurance? How do they pay their mortgage? How do they pay their utilities? How do they pay I mean, they're in trouble too. Everybody's in trouble. And the answer to all of it, when you say, "Oh, the government's going to bail everyone," well, sorry, but the government is just you and me. I mean, the government is just the collective of the taxpayer. We're all have to fund this, right? Everybody's going to have to fund this. Um, it's going to be difficult. Everyone's going to have to take their share of responsibility, right?
I would assume that the government is going to do everything they can to make it worse. You know,
Well, the way I look at it, somebody was telling me yesterday, the day before, that it's about time that Alberta has its sale tax now because the government needs the revenue. And my answer to that is there's two ways of looking at it. And there's my way of looking at it and their way in terms of the person I was speaking to. And my way of looking at it is what you should do in a society is you should allow me and you to keep as much of money that we earn as we can for us to decide what we want to do with it. And you should tax us to the point that you need for infrastructure and for the collective good. That we all have to pay taxes. There's no question about that. But then the person I was speaking to, their feeling is that we should pretty much give it all to the government and we should let them decide how much we get back. And I think they've got it backwards. I think that I should keep all of it and decide what I want to give to them versus them take all of it. And there's just certain governments and certain political persuasions in the world who feel like they should tax us 70%, and we should only keep 30% of what we earn, and then they take 70%, and then in their infinite wisdom, they'll decide what we get to get back. Well, I'm not going to live in that kind of world, because that kind of world never works. If you don't allow people to keep the bulk, and by bulk I mean over 50%. If you don't allow people to keep the bulk of what they generate and earn, then what incentive do they have to do it? Right? We might as well always all live in the collective in the gulag.
it's like that quote from the Gulag where that Russian guy says they pretend to
Solzhenitsyn.
pay us and we pretend to work.
Was that Solzhenitsyn that said that?
I don't know who said it. I can't remember whose quote it is, but it made me laugh because it's such a situation you can picture with any sort of government thing. Where like they pretend to pay, we pretend to work.
Yeah, yeah. So relative to the economy, I mean, I probably rambled on way too much. And
God,
probably
no.
the vast majority of people that are listening could care less about puts and calls. But I guess all I'm trying to do is I'm trying to think, if I was speaking to my three children, of which you are one of them, and I'm trying to help you guys develop a thesis for how you're going to use your employment income to invest in your life so that when you're 60 years old, you've got some shekels in the bank. I'm trying to create a dialogue with all of you so that you understand what your options and what the process is to do that, right? I think when I was young, I remember listening to my dad. My dad's biggest investments were, because don't forget we were in the Yukon, were in penny stocks. They were all in penny gold stocks and mining stocks, of which most of them went poof, right? Um, now, my dad was never going to be in a position that he was going to be an option seller, but um, I want my children to have a good understanding of how the financial markets work, how capital markets work, so that they can make intelligent decisions of what to do with their disposable income, so that when they're 60, they're not standing there with their hand out asking the government to help them. Um, I want them to be self-sufficient. I want them to be 60 years old and not need the CPP, um, or the or government pension. Right? Don't rely on the government. You should figure this out yourself. Which means you better believe in a society that believes in capitalism, that believes in stock markets, that believes in investment markets, that believes in the in that type of a system. Because if you don't have that, how will you ever be able to find an investment vehicle in your life that you can get ahead without being somebody that relies on other people to take care of you? Because I do not have any interest in living in Justin's nanny state, and that's what they want. A lot of people want a nanny state. They want free daycare. They want free this. They want free that. Well, when people say they want it free, well, I got news for you. Nothing in the world is free. Somebody's paying for it. And if it ain't them, it's somebody else. It might be free to them, but it isn't free to everybody. It's free. It's free only to, to somebody. And I don't ever want my kids to be in a position when they're old that they're relying on the nanny state to care for them. I want them to have built their own nest egg. They can do it themselves. And when they do that and they take those risks and they've employed people and they've generated and they've created things, well, for God's sakes, when they reach that point, leave them alone, because they're the ones that did it, right? And let them benefit from the risks and the hard work that they took, which is the way it's always been, hasn't it? You know, it's just, it seems in the last maybe 10 years of my life that I've just noticed this move towards the left, I guess. I don't know. We said we wouldn't talk about politics, but the move towards where people believe that the wealthy people stole it from someone. Well, I don't know if you would consider me wealthy, but I didn't steal it from anybody. I didn't win in a lottery. I took a lot of risks in my business career. I took a lot of risks in my investment career, and any success I've had, I've earned, because nobody was there to bail me out when I lost money. I don't recall anybody giving me money back from failed ventures, but I sure hear people calling me, different things with my things that have worked, right? Makes me crazy.
Everybody's got a hater. That's
Mhm.
just the rule.
That's probably true. But I mean, I think hopefully the three of you have had good examples in your life, between your mom and me, of people who have worked hard in our lives, and who have tried to create an environment where we could take care of ourselves. Your mom didn't get to where she was by asking people to do everything for her. She did it herself, right?
About gold, how is your gold doing?
Um, well, sometimes there's a disconnect between the price of gold and and gold stocks. And so I'm invested in both. I do own ETFs, that the GLD, which is a proxy for physical gold, and I own some gold companies. But the unfortunate thing is, when the market's in the middle of the meltdown that it's in right now, you would think, oh, good heavens, well, everyone, the flight to safety means everybody should be buying gold. Um, but the problem is that there's a lot of funds out there that are getting redemption notices. So people want their money back. And so they have to sell something to generate cash. And unfortunately, that means a lot of stuff. That means gold is sold. So what's gold at today? Gold is, the futures for gold are almost $1,600, $1,596. So, 6 months from now, gold could be back to 1,200. It could be 2,000. I don't know. I do think that in the next year, gold will go up. If I had to make a bet about what will happen with gold, my suspicion strong is that gold will be priced higher than lower, but it may not be in the short term. But sometimes usually gold decouples from the US dollar. When the US dollar is really strong, gold is usually on the weak side. But that's not necessarily always true. So you can't really use that as a predictor. I think people are surprised that gold isn't higher, but I think the reason it isn't higher is because a lot of gold is being sold in order to raise cash, because we live in a time that people need cash, you know?
Yeah. Even the people are selling their safety bubble.
Yeah. I think the one of the largest factors in this country of whether we're going to be ahead or behind in the next year is what's going to happen with the price of oil. Because price of oil today, where is oil at now? It's $21. I mean, maybe the Saudis can make money at $20, but pretty much nobody else can. You know, all the drillers, all the frackers, all the guys in Texas, all the guys in Alberta, deep sea drillers, nobody's making money at $20. So there's a lot of oil companies out there that are going to be insolvent soon. At $20 oil, that's not good. There's a lot of companies that are going to go under. And the problem is everyone says, well, why don't these companies just shut down their drills? Like in Texas, for example, why don't they just stop drilling? And the answer is because it's not that easy. Like I'm not an oil and gas expert, but it's not so easy to shutter a well and then just turn it back on again, right? It's a big process to do that. So a lot of these companies are still producing oil, but there's nowhere to sell it. There's no price to sell it. So they're storing it, right? It's going in Cushings, Oklahoma, and it's supposed to go in the U.S. Strategic Reserve, right? The United States has this massive reserve where they store oil, and it's going in offshore ships. But we're going to reach a point soon where the capacity is out and there isn't going to be anywhere to store oil anymore. So now what are you going to do with it? And this all started because, you know, the economy is one thing, but it's the war between the Saudis and the Russians, right? They couldn't agree on the price of oil. So it's the fight between Russia and OPEC that really is why, to a large extent, oil is where it's at. But don't forget, $21 is West Texas Intermediate. So that's the price of oil in the United States. But the price of oil in the Canada Western Selecting here, what is it, $7? I mean, the price of oil we're getting, because we only have one customer, and that's the U.S., right? Because we can't sell oil across the ocean. No, we can't do that. So, I mean, the Alberta companies, they're selling their oil for $7. Well, you can get you could buy a beer for the same amount of money that you can get a gallon of oil, right? So the price of oil, this is not a good thing. And I don't know what percentage of the Canadian GDP the oil and gas industry is, but it's a significant number. It's 10, 20%. It's something in that neighborhood. It's not insignificant. And so you kill that portion of the economy, you kill all the revenue in Alberta. Well, Eastern Canada and the company and the persons of this country that receive transfer payments, I'm not sure where those transfer payments are going to come from, because they can't come from Alberta. At $7 West Canadian Select for price of oil, we're in deep, deep trouble, right? Anyone who lives in Alberta right now, I know everyone likes to think Alberta just complains all the time, but Alberta's been a generator and a creator of wealth in this country for a really long time. And at $7 oil, that's not a good thing. So if we don't see oil turn around, I think the prospects for a recovery in Canada, certainly in Western Canada, in the next year, they're not very good.
Yeah, it's a crazy time to be alive. That's for sure. The disease is one thing, but the economy stuff that's happening at the exact same time.
Well, this is unprecedented. It's unprecedented in my lifetime that there's been a shuttering of the economy, right? That everything's been shut down. I mean, this has never happened in my lifetime. I guess it would have happened in the Second World War for periods of time. I mean, in terms of the stock market, right? But when's the last time? The Great Depression in the 1930s? I don't think it's ever been like this. I mean, unemployment in the next 6 months, what are we going to be at 20, 25%? What was unemployment in the Great Depression? In the 30s, maybe it was that. I don't know. But wow, yes, we're indeed. Yeah, I think of if you have a roof over your head and you got food in the fridge and you're still in good health, you need to hanker down and just be thankful for what you have, because um, things are tough. Think about your sister. Your sister's a university student, and
We
she's about
shouldn't
to
dox
finish.
her though. We shouldn't throw out too much information.
No. But your sister is a university student, and now the opportunity for her summer job is pretty much close to zero, right? There are no summer jobs for summer students right now. Would get a job in a restaurant? What restaurant? To get a job in I mean, retail, they're gone. Everything's closed, right? So there's hundreds of thousands of kids that are about to hit the job market and may looking for work that doesn't exist. They're all going home to live with their parents, right? It's going to be a tough summer.
It sure is. I feel bad for a lot of people that are stuck in situations now.
Yeah. Well, I'm lucky. My business is considered essential in Alberta, so we're still working, right? I have a lot of colleagues and a lot of friends and a lot of businesses that are all at home, all unemployed, all shut down, right? So, good heavens. Anyway, son, I need to pack it in here. I don't know how long your podcasts are supposed to be, but you probably have gone on long enough, eh?
Hey, it was absolutely what I wanted to happen happened talking to you about this because you know about the economy and ways and stuff that I don't, right?
Well, I've got the scars to prove it, but I would suspect that the handful of people that anyone who actually does listen to this will probably go away thinking, "What the hell was he talking about?"
I doubt that very strongly. I think that if somebody flukes onto this and they've got an interest in selling options, they will just love it. It's perfect.
Well, and maybe it will push some people to go start to research it, right? To say, okay, well, then I guess there is things I can do other than just buy a stock or sell a stock, and maybe it'll encourage people to go learn, right?
And you were saying how you like to help your kids, us three kids, but you know you're helping a whole audience of people, right? You never know.
That's right. A little pearl on the ground, somebody might pick it up.
Absolutely. Well,
All
thank
right,
you for coming on, Dad.
son, it was good to talk to you.